So hello everyone. Here I want to throw some light on the topic masala bonds. So firstly the question arises, what is bond? In finance, a bond is an instrument of indebtedness of the bond issuer to the holders. The most common type of bonds include municipal and corporate bonds. The bond is a debt security under which the issuer owes the holders a debt and they to pay them interest or to repay the principal at a later date, term the maturity date. Interest is usually payable at fixed intervals. Very often the bond is negotiable, that is the ownership of the instrument can be transferred in the secondary market. This means that once the transfer agents at the bank, medallion stamp the bond, it is highly liquid on the secondary market. Thus the bond of form of loan or IOU. The holder of the bond is the lender, that is creditor. The issuer of the bond is the borrower, that is debtor, and the coupon is the interest. Bonds provide the borrower with external funds to finance long-term investment or in case of government bonds, to finance current expenditure. Certificate of deposit or short-term commercial paper are considered to be money market instruments and not bonds. The main difference is the length of the term of the instrument. Now what is masala bonds? Masala bonds are basically bonds issued outside India but denominated in Indian rupees rather than the local currency. Masala is an Indian word and it generally means, as you all know, spices. The terms was used by the International Finance Corporation, the short form is IFC, to evoke the culture and cuisine of India. Unlike dollar bonds, where the borrower takes the currency risk, masala bonds make the investors bear the risk. The first masala bonds was issued by World Bank backed IFC in November 2014 when it raised 1,000 crore bond to fund infrastructure projects in India. Later in August 2015, International Financial Corporation for the first time issued green masala bonds and raised rupees 3.15 billion to be used for private sector investment that address climate change in India. In July 2016, that is the recent, the SDFC raised 3,000 crore rupees from masala bonds and thereby became the first Indian company to issue masala bonds. In the month of August 2016, Public Sector Unit NTPC issued first corporate green masala bonds worth 2,000 crore rupees.
Let's talk about how masala bonds help in supporting the rupee. The bonds are directly linked to the Indian currency, so investors will directly take the currency risk or exchange rate risk. If the value of Indian currency falls, the foreign investor will have to bear the losses, not the issuer, which is an Indian entity or a corporate. If foreign investors eagerly invest in masala bonds or bring money into India, this would help in supporting the rupee. The issuer of these bonds is shielded against the risk of currency. These currency fluctuations typically associated with borrowing in foreign currency. Currently, these bonds are listed on the London Stock Exchange. So, what are the norms of RBI for masala bonds? RBI, the Reserve Bank of India, allowed issuance of these bonds by Indian corporates as part of its fourth bi-monthly policy statement for the year 2015-16 on September 29, 2015. Masala bonds should have a minimum maturity of 5 years and there is a $750 million per year limit for borrowers, which can be exceeded with the RBI approval. We will understand how masala bonds come into existence. The concept of masala bonds was introduced nearly 5 years ago by the government and the IFC, International Finance Corporation, to stem the record fall in rupee due to capital fight spurred by a severe current account deficit and the tapering of quantitative easing by the US Federal Reserve. On June 27, 2013, RBI said current account deficit stood at a record 4.8% of GDP or $87.8 billion for the full 2012-13 fiscal. The trade data spooked marked on the same day with the Sensex falling 590 points, rupee breaching 66 level against the dollar, and 10-year government bond yields climbing to 8.5%. Interestingly, the Sensex had gained 600 points in the previous 3 sessions. The rupee closed at a record low of 66.24 to the dollar, down 194 paise from the previous close on the account of heavy dollar demand from oil importers in the month end. The record crash in rupee brought the UPA government into the action. The government, in consultation with IFC, International Finance Corporation, decided to launch rupee denominated bonds in the international market. IFC launched IFC launched the first offshore bond program of $1 billion in October 2013. From 2013 to 2014, IFC issued 7 tranches of offshore rupee denominated bonds, settled in US dollars and linked to the rupee foreign exchange rate, for maturities ranging from 3 to 7 years. Later, the bonds were referred to as MASALA bonds.
Let's see who can invest in masala bonds. Masala bonds are made for foreign investors. Foreign investors who don't want to expose themselves directly in Indian market, they can invest via masala bonds. The masala bonds give higher return than investing in their own country. If the investor invests his returns in home country, the bond yielding is hardly 2%, whereas rupee denomination masala bonds will give them 7 to 8% return. Like HDFC, NTPC and Indian Bulls Housings are among Indian corporates which have raised funds via this option. The subscribers of these bonds can sell rupee bonds to the third party, but the procedure for the issue cannot be issued for real estates or capital market investment. However, the procedure for these bonds can be utilized for development of integrated township, affordable housing project or any other infrastructure development projects.